Welcome to the Startup Grind.
Hear me pretty good? If I need to yell, I can certainly do that. I have 3 kids, so I can yell pretty loud. Anyways, well, thanks for having me. Do you like these cool chairs?
Yeah, you're gonna fall asleep.
I know. I feel like
Thanks. I'm sorry.
these are the cow chairs. I love the cow chairs. So, thanks again for coming this evening. Appreciate it. So I typically start these things out with, as we talked about before, by kind of getting a better understanding of kind of where you came from, kind of where you're going, that kind of thing. So if you want to talk a little bit about where you're raised and
Sure.
that kind of stuff, and we'll go from there.
Well, I grew up in, can you all hear pretty well? So hold this microphone close enough without chewing on it. I grew up in South Dakota. There's a little tradition, the roads there kind of go one way, they go out. Not a lot of people stay and live there. It's a huge farming community. Much to my parents' dismay, I didn't stay around and help run the family bank or the businesses that they had there. They still live there. So small town, Platte, South Dakota, 1,500 people. Went to people find this amazing. My grade school class was 12 people, my high school was 25, and my college was about 250 graduating class. I went to college in Northwest Iowa at a college called Dordt College. And I say that people go, Dordt College? It's D-O-R-D-T. It's in Northwest Iowa. It's a Christian college. Graduated there in 1984. Another unique thing about me, when going to school, I logged, well, they called it lugging at the time, but we loaded frozen hog carcasses onto semi-tractor trailers from midnight till 8 in the morning. I did that 4 nights, sometimes 6 nights a week, going to college. So I kind of had a full-time job going to college for the last 3 years. Moved to Colorado because my wife had a job after college and I didn't. I spent my first 3 months in Colorado building decks. I still remember standing out where Glenmore Country Club is today, listening to Pete Dye try to measure how long the hole was going to be there that he was working on. It was a deck for a big family doctor. But all of a sudden in about October it started snowing and I said I didn't go to college to do this, and applied to a job in the paper, which I don't think anybody does anymore. I think they all apply on those lists. We'll get to that later, but went to work for Total Petroleum, a pretty prominent oil and gas company as an entry-level accountant. They subsequently got bought by Diamond Shamrock. I worked for them for 2 years and then got recruited by Price Waterhouse. Today it's Price Waterhouse Coopers. I also tell people I can't say the C word because they've merged after I left. So it's always PW to me or just Price Waterhouse. Which was pretty untypical of Price Waterhouse to recruit somebody from industry. They tended to hire people right out of college. And they would have never recruited at Dordt College in Sioux Center, Iowa. So kind of a non-traditional way to get into then what was they called the Big 8. It went to the Big 6, and today they're now the Final 4, the big firms. So spent 10 years at Price Waterhouse. A great career, and I think some of my experiences at Price Waterhouse really drove what happened after Price Waterhouse. I spent the majority of my career there working with early stage companies, startups, mostly helping the majority of them, at least at the early stage, clean up their equity sections, all their stock options. And still today I hear of companies that CEOs will hand new employees a stock option that thing goes in some drawer somewhere, and all of a sudden nobody knows who owns any of the equity of the company. And we spent a lot of time helping companies get that all straightened out, and it was really fun. You were more proactive. As an auditor, you kind of think of us always coming in after the fact, right? And you're always kind of telling people what they did wrong. It's not a very fun environment sometimes. And so I left Price Waterhouse with an opportunity to go and become CFO for a technology company called In-Session Technologies, and probably nobody here has ever heard of them, but they were an ATM software company. We sold to a company in Omaha in '99, but the reasons I left was that the firm had a policy or procedure to become partner at the firm. You had to transfer, you had to move out of state and go get exposure with other partners. And I didn't. I love Colorado. I've always loved Colorado since I came here, and I didn't want to move.
So when you were at PwC, you said you were involved in early stage startups. First of all, how did you was that opportunity given to you, or did you seek it out, or was there something about it that you were doing that drove you to that group? And maybe give us a little understanding of at that time, what were some of the nuances, if you will, of startups back in the mid to late 80s?
Sure. Pricewaterhouse had a thing called the small business. Yeah, sorry. Pricewaterhouse had a small business group that I went into when I first joined them, and we would audit anything that needed an audit, which was a mistake. And so we ended up with companies that we shouldn't have been auditing, that were never going to grow. But we then turned that into following a model that they did very successfully in Silicon Valley, which was go in very aggressively at the early stage companies, something these early stage companies could afford fees-wise, and then grow with them. And, you know, as a firm, you hope to make that money back later. But got involved. We started specifically a high-tech practice in Boulder. We opened an office in Boulder. Boulder, the people at the time there wanted to be serviced by people from Boulder or from Boulder County. They didn't really want to get serviced by people from Denver, and so we thought it made a difference. And we also had a partner that was very focused on technology. This partner on, some of you guys might remember this, Storage Tech and Exabyte, and that were the two big Pricewaterhouse clients. And at the time, software was really becoming kind of a big thing. You know, came from middleware and software, and then from an accounting perspective, it was all around revenue recognition. We helped kind of write some of those rules. So we were very involved in that kind of in the early stage. Learned a lot about software as a service businesses, and we maybe talk about that a little bit more later, about how important that is. As you're starting your companies, I can't tell you, and a lot of people here know that, the valuations of these software as a service companies are much, much higher than, say, just a services business and or a enterprise software company. But we also went proactively, said we were kind of a small firm with big firm resources, and we would win almost every proposal we went after in the software business. But they were all pretty small companies, and we weren't getting the recognition nationally at Pricewaterhouse. So we proactively went after a company some of you might recall called J.D. Edwards, which was the largest software IPO in 1998 in the United States. And my only regret for leaving Pricewaterhouse was I spent 5 years on J.D. Edwards, and Murphy's Law, right? It was down here in the tech center, and the office was not lived in Boulder, so I was commuting the wrong way. But because I did all the work kind of to get them ready for that IPO, and then left before that IPO happened. Not that, you know, the Pricewaterhouse employees make any money on an IPO, but it would have been an awesome experience to actually go through that big of a company. So that's really where I kind of cut my teeth on the the software industry.
So in the startup phase you had mentioned before, and I think we talked about it earlier when we met, the importance of having, and I think most of the folks in this room would probably understand that more than folks that are not in this room, about the importance of understanding where your financial as a whole, right? We talked about stock options, we talked about all these different things that companies do when they get started up. They give away this, and they give you this, and they got equity, and you got all these different things, right? So explain to me, or to the folks here, a little bit about, first of all, the importance of that, which I think most people understand, but also, how would you, when you're into an organization, how do you relay that information, let's say to CEO, for example, or to a group of founders that may or may not understand that as well as they should, or so how would you go about doing that?
Sure, a couple questions there. I mean, I see a lot of it even today through Lou's List. where companies are looking for a controller, a VP of finance, or a CFO, whether that be full-time or part-time. And a lot of times it's a little too late, or it's later than it should be. I believe that you should, as an entrepreneur or founder, get someone involved very early to take care of a lot of things and mistakes that get made that you kind of got to crawl your way back out of, whether that be the stock option thing, or we see a lot of times or hear a lot about contracts that get negotiated with side agreements or different deals that just probably wouldn't happen, I don't think, if you had a CFO. Also, tracking your metrics and your data from day one is key. I think it's very, very important, and having that data available. And I'd encourage everyone here to, even if you don't have to go get a virtual data room and spend a lot of time with that, use Dropbox. There's a ton of free services out there, keeping all your documents, but getting a CFO or a controller or a good accountant at the early stage to keep track of all that stuff for you. We did a recap at Catalyst, so a little bit of history on Catalyst, just to kind of help answer your other question as well, which is how do you explain to your founder, your CEO, the importance of all this stuff. When I got to Catalyst in 2004,
tell us how you got there first.
Oh, sure.
Maybe you can answer that question.
Yep. Let's see. I went out to Pricewaterhouse in 1997 and worked for about four different startups, sold 3, shut down 1. I probably learned the most from the one we shut down.
I'm going to come back to that
Yeah.
one in a second.
Of a few things not to do. But I was a consultant for one of the companies that we sold, and Silicon Valley Bank actually was the one that referred me to the CEO of this business, Catalyst, and it was formerly called K-Share. The CFO of that company, they had a CFO. He was leaving to go start his own business, and he went through a process to help the CEO find a new CFO. And it was kind of good news, bad news. It was I was referred in by Silicon Valley Bank, and I still remember it was right before Christmas. The CEO called me. He said, "I got good news and bad news." He said, "Good news, you're still in the run, and the bad news is my CFO's got 200 resumes that they're going to look at." So after I got back, he got back from vacation. He says, "I still got good news and bad news." He said, "The good news is you're still in the running, but we're down to 10 people, and we're going to interview all those folks." And so I went in there and interviewed with him. I came in, I didn't wear any socks. I should have not worn them today. But, and I wore jeans. He told me we were very casual, and I think we just hit it off. He was in jeans, no socks, and loafers, and so we've hit it off ever since. And but he's learned a huge lesson about the importance of spending money, the importance of, he's a lawyer, so he also understands the importance of contracts and documentation and all that, so that was helpful at least. But he went through a whole period of time where he didn't understand the importance of every dollar that this company was spending, and he almost drove it in the ground prior to this other CFO getting there. And so I think relying on CFOs and the finance and accounting people to help him and help those CEOs understand the importance of that, the importance of metrics and driving that. Because when we went for a capital raise in 2005, we didn't have a lot of the historical metrics that we should have had when we were trying to raise money. So we kind of had to go back and dig those up. I don't know if we mentioned this or not, but Catalyst is a spin out of the law firm of Holland & Hart. It spun out of Holland & Hart in 2000. Kind of dilly-dabbled around and got lucky finding a couple customers to help them build their technology and pay for it along the way. So they didn't really have to raise a lot of money. The law firm put in about $2.5 million, and in 2005 we raised $4 million, gave the law firm their $2.5 million back, kept the $1.5 million, and we were $3 million in revenue at the time. And we grew the business through 2012 to a little over $35 million in revenue. In 2012, we did a recap, and for those of you that may not know what a recap is, normally what you'll do is raise additional money from new investors to buy out your old investors, and then a little additional money or a lot of additional money to put into the business to help you grow. In our case, in 2012, we did a recap where we raised about $32 million, but we gave all that money to those shareholders that put $4 million in. So most of those guys, they all got 10 times their money in 7 years. But the importance of what we did for those 7 years of growing the business and tracking our metrics and having a data room, our close was really quick. We got accolades from the investors that they've never seen, data room so organized and so quick. They could actually do almost due diligence the day they signed the term sheet. They didn't wait for us to scramble around and get that all done. And that was they had a large amount of confidence in the numbers and in the financial records of the company.
So with that said, I mean, that's a great story. What are some of the, we've talked to a couple folks here and I've talked to other folks around, putting together your financials, right? You need to have good financials. I mean, we've all heard that, right? What are some of the key components? There's a lot of stuff in a financial statement. What are some of the key things that, first, people kind of, they don't take, I don't say seriously, maybe they're not as diligent about it. What are some of the ones that you've noticed in the past where people don't take it to that level that they need to, right? Especially to defend that when it comes to, doing due diligence, for example, or something that you've noticed, that you've experienced.
I think it depends if you have a banker, a bank involved, or you have debt that seems to increase the scrutiny on your financials probably quite a bit more. But, there's a move afoot to make the financials a whole lot simpler in our profession because there's a lot of people that don't really need to understand or have monthly the impact of, income taxes and all the stock option expense and all that stuff. Nobody really cares. What they really care about is cash flow, right? Cash flow and revenue growth. I mean, I'm not telling anybody in this room anything that they don't know, but there's a lot of nuances. Revenue recognition is probably one of the stickier wickets in the software industry because the rules continue to change. How you apply those rules to your particular business continue to change, and so getting that right is probably one of the key things, and then obviously making sure you can keep track of cash. But the other is trying to get your financials closed relatively quickly at the end of each month and not try to wait too long. I mean, get metrics in place and things in place so you can tell your board and your management team how well you're doing. Don't take 30, 45 days, 60 days to do that. Try to get things in place so you can do that almost with a dashboard. And that your dashboard pretty much equals what your financials are going to look like even when you actually, your team actually does get them closed.
So when you're out raising money, and you're putting together something, what are some of the key things that you would suggest or have suggested in the past that are kind of more upfront from a potential investor than from a numbers perspective, a cash flow? But what are some of the other things, especially if you're going to use it for growth, right? What are some of the things that investors look at that more often than not on a financial or a revenue statement?
For us, I can give you a specific with Catalyst. What they were looking at really was new logos. What's your sales penetration rate and new clients, right? That's a big one for investors because particularly, I think most of us in this room that are working for either venture-backed firms or private equity firms, that's what they're all about, right? They're all about growth and less about profitability. And so making sure you have all that kind of lined up and can show that what you're doing from a sales and marketing perspective is actually generating those new clients. And we actually had a problem at the time when we did our recap is we had a huge customer concentration issue. We had good news, bad news. Good news, bad news was it was about 40% of our business, but the good news, it was one of the largest companies in the world. That was our client. And so it was, and we were having a little difficulty with our product or our platform getting a new one, getting out to market. And so there was some risk in our business about our ability to generate new clients. But that's probably one of the bigger ones. And then there's always the obvious stuff of when you're going to make sure you have your historical financials done either quarterly and annually, and your tax returns and all the articles of corporate, all the normal due diligence stuff. Your attorney can give you a list of those, and you can keep populating those in your Dropbox or whatever. But Yeah, focusing more on clients and customers and contracts, I think, is the biggest thing, particularly in these high growth businesses.
So in your opinion, do you think from a company that's raising money, in your opinion, do you think they should spend more on sales and marketing versus operations? What do you think the split should be between the two? I'm curious. So like as I say,
Yeah.
because that's a debate a lot, I hear.
The model, I remember a college simulation model, and we got a tip from the previous year's class that said, dump everything you can into R&D and you'll win the contest. And we did, and we won. But I think there's a point in a company's evolution where you have product risk or development risk, and I think at that time that's where you ought to be spending your money in operations and the development of the product. And once you're kind of through that phase, and you're always nursing that phase along, but I think there's periods of time when it's higher than others, and then there's another time when it's time to step on the gas in sales and marketing. And sometimes there's inflection points that you can see, and other times there's not. Catalyst, we're kind of there. I'd say 2 years ago we were a bit at a even though we're a $30 million business, we were at a product kind of what I call risk stage. We had a brand new platform. We're doing something very new in the industry that none of our competitors are doing, and we took a big risk. And 2 years ago, there was risk that wasn't going to get done. And so we didn't and couldn't really step on the sales and marketing engine at that time because the product wasn't ready. But today that's different. That product risk is gone. I just went through we call it, some of you will know this, a 409A valuation, which is they try to value your stock so you can issue stock options at fair market value. And we just went through that, and I spent a bunch of time talking to the people about this very thing, about how, last year when you did this product risk still existed, but today it's more of a sales and marketing execution risk. And that's a big change for us. You're going to see us probably double our expense in the sales and marketing arena over the next 12 months.
So that catalyst. I want to talk first about the SaaS stuff that you talked about before. In your opinion, you said that's a place to be, right? Give me, from a financial perspective, why is that the place to be?
Yeah, and again, maybe I'll give it to a couple examples. I sit in our senior management team meetings, and I got a guy who's been in the service industry forever, and he runs our professional services. And here's how he talks about it. He goes out to customers and he leads with, we got these great people and we got all these services and we're going to treat you really well. And oh, by the way, we have this product back here that's going to help you do what we need to do. It's kind of back here and we can use it if we want or whatever. And I go, no, don't lead that way. I said, why don't you lead with, we got this awesome software platform. We're going to charge you a lot of money to use it. And by the way, we got all these bright people in the back that can help you if you need that. And it's just a mindset. I would argue that services business, most of them are probably worth somewhere between 0.5 and 1.5 times revenue in that range. And software as a service businesses, software businesses are going to be worth anywhere from 2 to 10 times revenue. But if you're software as a service where you have very little churn at all and you have very sticky revenue, you're going to get value. Today you're seeing companies all the way from 6 to 10 times revenue. So when you're valued that high and that revenue that you generate is valued that high, you spend a lot of money in sales and marketing to go get that revenue. So I'd encourage any of you here that are starting businesses, if you can turn your model into something that's more of a subscription-based model versus what we're struggling with at Catalyst is that utility-based model, pay for what you use, I would encourage you to do that. We're at a little bit of a crossroads and a dilemma at Catalyst because we are, like I said, a utility-based model. So you give us data, the more you give us, the more you pay. Once your legal matter is over, you stop paying us. And you can see big spikes in that process. And so we're trying to change that. We're trying to change where we can go charge you a monthly or whatever quarterly subscription fee, and then we don't care how much data you give us. And that's a hard change to make, but again, back to my biggest recommendation is you can create or build a business that's software as a service, to use today's terminology. I'd encourage you to do that. You'll be rewarded heavily for that later.
Okay. So in relationships between CFOs and CEOs and all the C-level, where do you think, I'll say necessarily the importance, but in your opinion, the relationship between those levels of management? I mean, I know from my own experience that CFOs were always, in my opinion, a lot of times they were kind of more sales prevention as opposed to sales support. So, in your opinion, how do you get a CFO that is sales oriented, right? I mean, you probably experienced this in the past. And how do you convince, let's say you have a CFO that is too sales oriented, if that's possible. How do you manage, if you will, as a CFO, those relationships, because it's important that you do that, and the nuances between the different groups, between sales and marketing and operations and R&D and everything else, and the money that's being spent with those. So maybe give us a little bit.
It's a really good question, and it's one I struggle with all the time. We're trained to say no. We really are, I think, and to watch expenses, and it's really, I think, what I think works best is if you can have a really good relationship with your CEO and or the VP or executive VP of sales, and if you all know that that's kind of your role, that you're not trying to prevent sales by saying no to certain things. I think if you have that understanding and kind of work through that, I think you'll have a better relationship and a better outcome. But if you're speaking from Catalyst perspective, when you're private equity owned, they only have one motivation, and that motivation is to make money, and that is all driven by growth. And so if you don't grow, you're going to have troubles down the road. Either they're going to dump you, or they're going to find a new team to do to grow the business if you can't. Yep. So I think at the end of the day, it ultimately ends up to be how good a relationship can you build with your executive team, and get a mutual respect and an understanding of where you're coming from when you're trying to curb or control expenses, and some of it I think is just healthy skepticism too, is questioning people why or where they're spending the money. We had a long conversation this morning with our chief marketing officer about where we're going to spend a bunch of the new marketing money, and there's always healthy tension there, because the CFO always wants to see what the ROI is on the marketing spend, and the marketing folks can't answer that question in all cases. So, because it's a little bit of a trial and error and test and see what happens, particularly in some of these early stage markets.
Well, next question I have is about List. Maybe you can talk a little bit about how that got started, what it is. A lot of people here are familiar, but maybe give us a little background on that, where it's going.
Yeah, who knows where it's going, but. When I was at Price Waterhouse, I ran a kind of executive networking group where we would invite our clients and our prospects to a quarterly luncheon, usually held at a restaurant some folks here might remember called Ladicio's in Boulder, and we'd provide a speaker. It usually was a venture capitalist at the time, or a CEO that had an interesting story or an exit. We tried to stay away from geeky accounting stuff for topics, and we'd get about 40 to 45 people that would attend. And when I left Price Waterhouse, I became a member of that group. And in the late 90s, there was this term called peer-to-peer networking that was just coming out. It was pretty big. I always describe it as the managing partner at Price Waterhouse never wanted to go to the Denver Bronco football games box, because he always ended up talking to accounts payable clerks. He wanted to talk to the CEO and the CFO of the company. And so it was, how do you get to network with people that are your same level and that understand you, and can share your challenges and that kind of thing. So that was a big deal at the time. When I left, I became a member of the group. It kind of disbanded in about year 2000, and I think in 2001 or 2, a bunch of us got together kind of at a restaurant. We started talking about networking, and accountants are goofy networkers. I've seen it happen too, right? They'll walk into a room, if they don't see somebody they know, they might walk right back out and go home and hope nobody saw them. How many in here have ever done that? Anybody here ever walked into a room, didn't see somebody? Or you go hang out by the bar, maybe grab a drink, and hope that somebody notices you or somebody else comes up to you and says hello. So we said, what if the other one we hated was you go to these, used to be called the Spree Entrepreneurial Awards in Boulder, and we'd go to these and you'd like the first half hour, 45 minutes where you could have a beer with somebody and then maybe meet somebody new, but then they kind of flashed the lights or rang a bell and made you go sit at a table with 10 people and eat rubber chicken, and then you listen to a bad speaker, or you look at your watch and go to the bathroom and then sneak out because you'd rather be home putting your kids to bed than listen to that speaker. So we said, what if you could go to an event where there was no speaker, no fees, no agenda, and you could bring a friend? So we said, well, let's start this networking thing. So at the same time, I was a Sequel. Some of you might remember Sequel Venture Partners. I was one of their 35 portfolio company CFOs, and so I had their names and their list. And I used to call the CFO of Sequel and ask him different things about Silicon Valley Bank. We were trying to do a loan with Silicon Valley Bank, and said, what's the hot buttons? Is it warrants? Is it interest rate? Is it covenants? What is it? And he goes, time out. He said, I'll answer your question if you promise to lead a CFO conference for my 35 portfolio companies. And I go, why? He said, because you're one of our most experienced CFOs, yet you call me to ask me questions about different things. You guys got so much going on, you can't learn all this stuff. But I got all these young CFOs and young controllers at these companies, they'll never call me. And inevitably, my other board members get into a board meeting where these guys have made mistakes, and they yell at me as the CFO of Sequel and say, how come you're not talking to these people and getting them together? So anyway, he decided to help kind of pull that together. We emailed about 80 people and said, we're going to go to Old Chicago up in Superior. We're just going to meet in the bar. So as fate would have it, it was a snowstorm that night. We had about 20, 25 people showed up. Not bad, but 2 days later, I'd get emails from people and said, hey, if you ever do that again, can you add some people to the list? Or add so-and-so to the list, they'd like to come. But where Lou's list really spawned was a guy named Mark Veliquette. He's the CFO at Logarithm today. He emailed me and said, I'm looking for a controller. Can you send out to some of the folks that were there that night that I'm looking? I was talking to, but I didn't get their cards. And I said, wonder what the harm would be of sending that notice out to all 80 people that we invited. And that's what I did, and that's kind of the start of Lou's list. And fast forward to today, it's almost, I'm waiting to announce this, hopefully early next year, 10,000 people. And it's, and I send between 110 and 150 jobs a month to people, all the way from bookkeeper to CFO. I also have a senior list. It's about 650 to 700 folks, which you had to be in a C-level job, a controller or above, that I also keep on the side. I could spend about 10 minutes talking to you about all the limitations of Microsoft distribution groups in Outlook. And so I switched my technology to Google Groups and Gmail, which is awesome, several years ago.
A lot easier.
A lot easier.
Well, I tend to ask people to ask a couple questions. Okay?
Sure.
Okay. So, if you have a question for Lou, now's the time.
You talked just briefly earlier about the CFO that can say yes. We were just having a conversation about that. I wanted to hear a little bit more about the change between traditional CFO, say 20 years ago, or maybe longer, and today's startup CFO and the necessities of that attitude.
Okay. So the change between the CFOs of
yesteryear
to today, and how that relates to the yes CFO. Fair enough? Okay.
Yeah, I think again it's an alignment, because if the CFO is going to say yes, it's because there's a reason you're going to spend the money, right? Usually it's around money or hiring people. Those seem to be in the startup world the two major biggest things, right? Or do we spend money on recruiters or those kinds of things? And I think it's all about whether or not you collectively decide that's going to help us grow this business, right? And obviously you can get into a debate of whether or not that's going to do it. Well, why do you need another customer support person? Just work more hours. You know, I think it's a mutual respect and a good understanding between the executive team members of why you're doing this and having a healthy discussion around it. We do that today. I see a lot of companies which are different than us. I'm not saying it's right or wrong. They kind of set budgets, they give them to their managers or their VPs, and they kind of go after it. We've chosen not to do that. We've chosen to have different, every time we have a hire in the business, that gets raised to the senior management team, even in a $30 million business. And obviously in a $1 million business, we would always do that.
Yes.
I work in the private equity oil and gas sector, we've been looking at our startups and ventures, but how do you address the looming management shortage gap, or AKA the great crew change, be it for oil and gas and energy, or just the shortage of engineers forecasting in general from your perspective?
Well, maybe the increase in crude oil prices would help. I'm not sure.
Here's a question. Sir, how's the, go ahead and say it again.
The question is basically in the energy industry specifically, there's this looming management shortage gap between people who got in the industry in the 80s and people who've kind of started to get into. And so they're predicted right now that more than 5 million people are eligible for retirement at this very moment, and that for the next few years they might run out of management. But as we said, the way oil prices are right now, I don't think anybody's going anywhere anytime soon. So
Yeah, hopefully new technologies in the oil and gas industry help drive some of that enthusiasm, I think, around the industry. Software around that, I would think, to do that. Fracking, I'm assuming, has helped some of that. I don't know, helped some of the startup businesses. My daughter's in the engineering program at college, and I see a lot of kids entering that engineering field. Whether they go into oil and gas engineering or all that, I don't know. But my answer would be, you got to make it fun for people, and I think oil and gas has a stigma a little bit about maybe not being as fun for people, right? And I think that's why they lose entry-level folks going in. Although, sitting back here is a brand new employee for Icana. Maybe she should be answering that question.
We'll have to talk with her later.
thank you.
Yes, sir.
So you were talking about the ROI conversation with your marketing department. What is your homework around what causes you to raise red flags on ROI from the marketing department? What background gets you to that point?
Yeah, it's more experiences. Trying Google AdWords and watching them not work, right? And so now when the marketing group says, we're going to go do that, I have a healthy skepticism that says, well, how do you know it's going to work? Similarly, all the cost per click and cost per thousand impressions and conversion rates and all those things. We're just embarking on that at Callis. We haven't historically done that. We've done more trade reg, going to trade shows, but haven't done a lot of the kind of so-called digital marketing and really seen an ROI. So we're going to go out there with a little bit of hope that some of this is going to raise a little bit more awareness for a new product that we have. But I'm also challenging our CMO quite a bit to really focus on where she thinks she can get the biggest bang for the buck, whether that would be in different sectors of that digital marketing in our particular industry. But I also made sure that she's going to track in 6 months, she can come back to me and say, this didn't work, or this did work. And I think that's just another one, going to be another experience for me to be able to challenge that or say yes to that one in the future.
So, second question: when you come in on like those prices per click-through rates or whatever it is, are you benchmarking against something in terms of some sort of cost?
I asked that question today. It wasn't going to be me. I asked that of our chief marketing officer, and she's got experiences doing it. So in this particular case, I'm going to trust her to go negotiate the best deal for those. And on occasion, we've done a little bit at a new Bloomberg site. We just did it. I tell you, we spent 30 grand, $5 grand a month for some new site. I can't tell you we got one lead out of that whole thing. But what we did do is tell Bloomberg that, and we now are getting a whole bunch of other stuff, and we're starting to work.
That's good. That's good. Last question.
You mentioned having worked with a startup you had to shut down. Can talk about some of the lessons you learned through that, some things to avoid?
Yeah, I did. It's not secret. It was a company called Product Buzz, and it was what we were attempting to do is in the home health arena and the pharmacy arena. You walk into a doctor's office, you see these oversized magazines, and they have home health care products in them. And what we tried to do is digitize all that and sell that online, move that to online. The CEO was a publisher. His family and the whole industry, or his whole family history was in the publishing industry. So the whole thought was to put all that content online and get the people that were normally buying those things through those magazines to buy that online. Well, the biggest flaw back then was spam's illegal. Today, I'm not sure it is, but back then it was, and you had to spend a lot of money to go get your subscribers, and it just didn't work. And two quick stories on this thing, but one was when I got there, they had spent almost all the money they had raised in like 3 months building the infrastructure. This thing the infrastructure they built for this business could have handled the business 5 years down the road, and I don't know how they let that happen. The other one, which was kind of funny, and that's one of the reasons it failed, right? They spent all that money on all this equipment and infrastructure, and they didn't need to. They needed to crawl, walk, run, and they didn't do that. But the other one, and some of you guys may know this person, his name's Rick Patch. He was one of the investors with Sequel in this deal. He told me the day he interviewed me the 2 weeks prior for the CFO job, and on Monday when I started, he came to the office and said, "You need to go fire the CEO's wife." And she was the VP of sales, and which was another problem why that business failed. But I said, "Well, why didn't you tell me that when I interviewed?" He says, "Because then I didn't think you'd take the job." So anyway, we had to do that right away. But
Well, cool. Well, I appreciate you being here this evening.
Thanks,
And
Fred.
we're going to be around here till 9 or beyond, so if you're going to stick around.
yep, I can
Great.
stick around a little.
So if you have any other questions for Lou, he's going to be here. So thank you very much for
Thank
coming.
you.